You know when you're scrolling through stock charts and you see a company that just looks impossibly cheap? Its price has been absolutely hammered, and you're thinking, this has got to be the bottom. This is the value play everyone else is missing. Well, today we're pulling back the curtain on a massive hidden risk, a ticking time bomb, really, that's set to detonate in 2026 across three very specific sectors. It's time to go zombie hunting.
Okay, let's really break this down. Because this quote right here, this is the heart of the whole mystery. How can a stock that looks like such a bargain actually be a trap? Well, it all comes down to a simple, brutal fact that most people just overlook because it's buried in the fine print: the due dates on the company's debt. What looks cheap today could be facing a financial day of reckoning just around the corner. And that right there is what makes them a zombie. They're shuffling along, they look alive, but for all intents and purposes, they're already dead.
And this brings us to that classic investor term, the value trap. See, it's not a bargain, it's a trap. And these are often created by what we're calling zombie companies. These are businesses that earn just enough money to stay open and maybe pay the interest on their loans, but not enough to actually pay the loans off. They're just stuck in this financial purgatory. And the stock market? Well, it's always trying to look ahead. It's pricing in the fact that a company's dollar of earnings today might be worth absolutely zero tomorrow. So our job, right now, is to figure out if we're looking at a real deal or just a really well-disguised trap. So let's start by just tearing down this illusion of cheap. Why do these companies look so tempting in the first place? And why are our usual tools for spotting a bargain, like a low stock price or a simple valuation metric, why are they failing us right now?
This is absolutely crucial to understand. A low price, or even a low price to earnings ratio, does not automatically mean you found a good investment. Think of it like buying a used car. A low price tag is awesome, right? But if the engine is about to fall out, it's a terrible deal. For a company, a weak balance sheet and a mountain of debt, well, that's the faulty engine. A low PE ratio can't fix a business that is fundamentally broken. And on a more technical level, when a company's cost of borrowing money is higher than the return it makes on its investments, it's in big trouble. Every single day they operate, they are just digging themselves into a deeper and deeper hole.
So what is this big, scary problem that's creating all these zombies? This isn't some hypothetical, maybe it'll happen risk. This is a very real, very large appointment on the calendar with financial reality. And it all comes down to this massive wall of debt that's about to come due. Just look at this number for a second. Nearly $2 trillion. That is an almost unimaginable amount of money. And that's just the commercial real estate debt that's set to mature between 2025 and 2026. This isn't some abstract economic figure. This is a literal tidal wave of bills that hundreds of companies are going to have to pay back. Or, more likely, try to refinance at interest rates that they simply can't afford. And this timeline just lays out the story perfectly. Back in 2020, 2021, money was practically free. Companies loaded up on debt at 2, maybe 3%. Then, boom, the most aggressive rate hiking cycle in decades. And now, in 2026, those cheap loans are expiring. Imagine your own home mortgage suddenly resetting from a cozy 2% to a punishing 7% overnight. What would you do? You'd have to find hundreds, maybe thousands, more dollars every single month, or you'd be forced to sell. That's the exact same shock these companies are about to face, but on the scale of millions or even billions of dollars.
All right, so that's the problem. It's a big one. But this isn't about scaring you, it's about being prepared. So let's shift gears and talk about the solution. Let's build our own simple 3-step toolkit to help you identify these risky companies before they ever become a problem in your portfolio. This is how you really gain an edge. We're going to look at 3 things, and together they paint a crystal clear picture of a company's financial health. First, we need to know, when is the debt actually due? That gives us the timeline. Second, can the company even afford its current interest payments? That tells us about its profitability. And third, does it have enough cash on hand to survive the short term? That's all about immediate liquidity. These are simple checks, but they are incredibly powerful. First up, you've got to become a bit of a financial detective. You need to dig into a company's annual report, which is called the 10K, and find its debt maturity profile. This sounds way more intimidating than it is. It's usually in the Notes to Financial Statements section under a heading like Debt. You're basically looking for a table that shows how much debt is due next year, the year after, and so on. If you see a giant spike in 2025 or 2026, that's your first major red flag. Next, we check the interest coverage ratio, or the ICR. Now, this is arguably one of the most important health metrics in a world with rising interest rates. It answers a really simple question.
Are you earning enough profit to comfortably pay the interest on your loans? Think of it as a company's financial breathing room. A business that was perfectly fine when rates were low could be in serious trouble when that debt gets refinanced at a much higher rate.
And here's a good rule of thumb. If your profits are more than 3 times your interest payments, you're generally in a pretty safe zone. You've got a cushion. But if that number drops below 1.5, you are squarely in the danger zone. Any little hiccup in business, any dip in profits could mean you can't make your payments. Imagine two companies, both making $3 million in profit. Company A has $500,000 in interest payments. Their ICR is 6. They're safe. Company B has $2.5 million in interest payments. Their ICR is 1.2. They are in deep trouble. One bad quarter and they're insolvent.
And finally, we have the current ratio. This is the ultimate short-term survival metric. It answers one critical question. If you had to pay all your bills that are due in the next 12 months using only assets you could quickly turn into cash, could you do it? It's kind of like looking at what's in your bank account versus your upcoming credit card and utility bills. The legendary investor Benjamin Graham, he had a simple guideline built on what he called a margin of safety. He wanted to see companies with a current ratio above 2. That means they have $2 of easy-to-access assets for every $1 of bills coming due soon. Now, if that ratio is below 1, it is a massive warning sign. It means the company is illiquid. It means they literally do not have the cash on hand to pay their bills, and they might have to start selling off core parts of their business just to keep the lights on. So now, we have the tools to spot a single sick company. But what happens when lots of companies in the same industry get sick all at once? Well, this isn't just an individual company problem. It creates a risk of contagion, and we are seeing the clearest danger in this toxic link between two sectors, commercial real estate and the smaller regional banks that fund them. So here's how that contagion actually works. It's like a chain reaction. First, a property developer. Their loan resets from 3% to 7%, and they just can't make the new payments, so they default. Then, that bad loan just sits on the bank's books, becoming a worthless asset. And then we find out that a huge percentage of these exact loans were made by smaller regional banks. So for them, a few big defaults can spark a much wider crisis of confidence. And that's the key point right there. This becomes a confidence problem. It's not even necessarily about every bank being insolvent on paper. It's about people, depositors, getting nervous. We saw with Silicon Valley Bank just how fast a modern bank run can happen. It's not people lining up outside anymore. It's thousands of people pulling their money with just a few taps on their phone. Once confidence in a bank evaporates, it can become a self-fulfilling prophecy. And this whole thing kicks off a really dangerous feedback loop, what some people call a doom loop. So as developers default, they're forced to sell properties, and that floods the market. Office building prices fall. This means the collateral, the buildings, backing all the other commercial real estate loans is now worth less. So banks pull back on all lending to protect themselves. Less credit means less economic activity, which pushes asset prices down even further. You see, it's a vicious cycle that can spread from the financial system right into the real economy. Okay, so what does this all mean for you, the individual investor, who sees a stock in one of these sectors that's just been decimated and thinks you found a bargain? Well, this brings us to the final, hard-hitting, brutal truth of this entire situation. This is it. This is the brutal truth. When a retail investor buys the dip on a company facing a huge debt crisis, they aren't being some savvy contrarian investor. They are often just providing the exit liquidity, the cash, for larger, more informed institutions and banks to sell their positions and get out before the music stops. Think about that struggling retail company in those half-empty shopping malls. You see the stock is down 90% and you think it can't go lower. But what you don't see is the millions in debt maturing in 2026, and the big funds holding that stock and debt are desperate to sell it to you. So the next time you see that beaten down stock that just looks too good to be true, I want you to ask yourself this one simple question. Don't just look at the price chart. Become that financial detective. Check the debt schedule, check the interest coverage, check the current ratio. Because it's not just about the price, it's about the timeline. And knowing the answer to that question could be the difference between finding a true value investment and walking straight into a value trap.